Welcome to Talk Tickers. Today, we are really stripping the engine of the modern stock market down to the bolts. We're looking at a financial instrument that has arguably done more to change how the market feels on a minute-by-minute basis than anything else in the last decade.
It really is the invisible current.
It is. And we're diving deep into 0 days to expiration options, or as everyone calls them, zero DTEs.
Yeah, and it's the topic that just sucks all the oxygen out of the room when you talk to market structure analysts.
Right.
What started as this, niche little tool for tactical hedging has basically eaten the market.
Yeah.
We're looking at data now where zero DTEs are almost half of all S&P 500 options volume.
Nearly half. That's massive.
It's absolutely massive.
It's the shiny new toy on Wall Street, isn't it? You have everyone from, the retail trader on their phone hoping for a lottery ticket to these massive institutional players running systematic yield harvesting strategies.
Yeah, right.
And the central tension we need to resolve in this deep dive is, I think, crucial. Are these harmless tools for laser precise risk management, or are we staring at Volmageddon 2.0? Are we building a structure that's just priming the market for flash crashes?
That is the trillion-dollar question. And to get the answer, we have to look at the mechanics, the data from the exchanges, and, specifically that real-world stress test we just saw in April 2025.
Right.
Because that gave us the first real look at what happens when the system is under fire.
Okay, before we get to the fire, let's look at the fuel. For clarity's sake, let's just define the beast here. When we say zero DTE, we aren't talking about an asset class like a tech stock. We're talking about a time frame.
Correct. It is purely about the clock. Zero DTE options are simply contracts that expire at the end of the current trading day.
They turn into pumpkins at 4 p.m.
They do. And because they have 0 days left, they have zero time value buffer. Normally with options, you pay a premium for the time you have left for the potential.
Right.
Here you have no time, you just have now.
So they're purely sensitive to the immediate price movement. It feels like trying to land a plane on a very, very short runway.
That's a great way to put it. They are hypersensitive. We talk about theta.
Time decay.
Exactly, time decay. For a normal monthly option, theta is a slow leak. For a zero DTE, it's aggressive. It's like holding an ice cube in a blast furnace.
It's just melting in front of your eyes.
Rapidly. But they're also extremely sensitive to delta price movement. A small move in the S&P 500 can cause a massive percentage move in the options value. We're talking 500, 1,000% returns, or 100% losses.
In minutes.
In minutes. High risk, high reward.
And the scale here is just staggering. I was looking at the notes. Daily volumes in these SPX options are surpassing 43% of the overall daily option volume.
It's credible.
The notional values are hitting trillions of dollars per day. That's a lot of money changing hands based on what happens between, breakfast and dinner.
Right. And that volume is where the debate lives. Because when you have trillions of dollars of exposure expiring in, 6 hours, that creates pressure.
Of course.
On one side, you have the gamma trap argument. This is the idea that these options amplify volatility, that they make the market more dangerous.
The snapback risk.
And on the other side, you have data from exchange operators like the CBOE arguing the impact is de minimis, basically negligible.
De minimis seems like a bold claim for something trading trillions of dollars. It sounds a bit like corporate speak for don't worry about it.
It does.
Their argument is that the buy and sell flows are balanced, right?
But that's the crux of it. They argue that for every buyer, there's a seller. So the dealer, the market maker in the middle, isn't stuck holding the bag.
So in theory, it's a perfectly efficient market.
In theory, if the flows are balanced, the dealer just collects the spread and goes home happy.
But that feels like a fair weather argument. Sure, it's balanced when the sun is shining, but what happens when the boat tips? What happens when everyone wants to sell at the same time?
Which brings us directly to our result snapshot from recent history. We finally got a real answer to that question in April 2025. We had a real-time market stress test.
Take us back there. I remember the headlines, but what actually happened in the plumbing of the market?
It was the perfect storm to test the zero DTE ecosystem. You had a sudden wave of tariff escalations, geopolitical shocks hitting the newswire. The S&P didn't just drift down, it fell sharply. It was a volatility spike.
So everyone scrambled for protection at the exact same moment.
Exactly.
So did the market break? Did liquidity just vanish?
It didn't break, but it certainly acted as an accelerant. The analysis that came out in the April event was fascinating. It found that zero DTE options were not the root cause. The tariffs were the cause, right?
So news was the cause.
Yeah, but the options magnify the intraday swings.
Yeah.
Significantly.
This is where I want to slow down and really unpack that mechanism. We hear this term short gamma all the time now. It sounds like complex physics, but it's really about dealer incentives. Can you break this down for us simply?
Sure. Let's look at what we can call the dealer's dilemma. Market makers are there to provide liquidity. They're not trying to bet on direction.
They just facilitate trades.
Right. Now, when traders rush to buy puts to protect themselves, which they did in April, the dealers are the ones selling them those puts.
Okay, so the dealer sells a put. They're now on the hook if the market crashes. They've promised to buy stock at a certain price, even if it falls below that.
Exactly. Being short a put means you are short gamma. To protect themselves, to remain delta neutral, which basically means they don't care which way the market goes, they have to hedge.
Okay.
So if the market drops, the put they sold becomes a bigger liability for them. To offset that growing loss, the dealer has to sell S&P 500 futures.
Wait, walk me through that. The market is dropping, people are buying puts for protection, and to hedge, the dealers have to sell futures.
Yes, they have to short the market to offset the money they're losing on the puts they sold.
Which makes the market drop even more.
Precisely. Selling futures drives the price down further, which makes the puts more valuable, which forces the dealer to sell more futures to stay hedged.
It's a feedback loop, like a microphone getting too close to a speaker.
That's the perfect analogy. And it works the other way too. If the market bounces, they have to buy futures aggressively to cover those shorts. You end up with these violent intraday reversals.
Which we saw.
We saw that specifically on April 9th, 2025. The S&P staged a historic intraday rebound that was driven in part by these amplified hedging flows.
So it creates this gamma trap. The market becomes incredibly reactive, twitchy. It's not just moving on news, it's moving on the mechanics of the hedging.
It really is. The market adjusts almost instantly. But, there is a silver lining in the April data. Once that initial shock subsided, the market did stabilize.
It didn't spiral.
It didn't spiral into a systemic collapse like 1987 or the flash crash. The feedback loop eventually ran out of steam.
And interestingly, looking at the data, retail traders, who often get the blame for this volatility, they actually pulled back during the chaos.
They did. Retail share of volume dropped from about 57% down to 47% during the peak of the panic. They stepped aside.
And then they came back.
As soon as volatility settled into a VIX range of 25 to 30, they came right back. It shows that while the machine speeds things up, the participants are somewhat rational. They aren't just blindly throwing money into a burning building.
I want to step back and look at how we even got here. Because zero DTE isn't a new invention. It's not like it appeared out of nowhere. It's really an evolution of the calendar.
It's a classic example of financial innovation, creeping up on us slowly, then all at once. It started back in 2005. The CBOE introduced weeklies that expired on Fridays.
And before that, it was just monthly expirations.
Generally, yeah. The third Friday of the month.
It seems crazy to think about now. You just have to wait a month to settle a bet. Feels like the Stone Age.
Right. So suddenly you could trade the end of the week. Then in 2016, they added Wednesdays, then Mondays. And the cycle was finally completed in 2022 with Tuesdays and Thursdays.
And suddenly, every day is expiration day.
Every single day.
Right.
You effectively created a daily market for zero DTEs.
And that unlocked the strategies we see now. I think there's this huge misconception that this is all just a retail casino. Gambling is the word you see in the headlines. But the institutional adoption, that tells a different story.
It does. It makes for good headlines. The guy in his basement gambling his life savings. But the reality is more nuanced. Retail participation has exploded. I mean, a 75% increase between 2022 and 2023.
Wow.
But institutional adoption is massive. And they aren't just gambling. They're using these for yield-generating overlay programs.
What does that look like? Yield-generating overlay. That sounds fancy.
So imagine you manage a huge portfolio of stocks, like a pension fund. You can sell zero GTE calls against that portfolio to collect premium income every single day.
Okay.
Or you use them to hedge very specific risks. If you're worried about a Fed announcement at 2 p.m., you don't need a hedge for a month. You need a hedge for 3 hours.
It's surgical.
It's surgical precision.
And most of these trades, they aren't naked bets, right? That's a key distinction for systemic safety.
That's correct. Approximately 95% of SPX zero DTE trades are defined risk strategies. We're talking about spreads, iron condors, butterflies.
Explain defined risk for someone who might not trade options. Why is an iron condor safer than just selling a put?
Well, with a naked trade, if the market moves against you, Your losses can be theoretically infinite, right?
Right.
In a defined risk strategy like a spread, you buy one option and sell another. You might sell a call at one price, but buy another call a bit higher up. The most you can possibly lose is the difference between those strikes.
It's capped.
It's capped. It's built into the structure of the trade itself. And that's a critical firewall against a systemic blowout. If everyone was just selling naked puts, you'd have a catastrophe. But with defined risk, the damage is contained.
So the floor is solid. That's good to know. Let's pivot to the investor context. Because even if you aren't trading these things, they affect the water you're swimming in. If I'm an investor, I look at my screen, I see the VIX, the fear gauge at, say, 18, relatively calm. But the intraday market feels like it's ripping apart, swinging 2% up and down. Why is there a disconnect?
This is one of the most significant distortions of the zero DTE era. You have to remember what the VIX is. The VIX measures implied volatility 30 days out. It's calculating the expected range of the S&P over the next month.
So it's looking at the weather forecast for next month, but there's a tornado touching down right now.
That's a perfect analogy. We call this term structure inversion. During that April 2025 event, we saw implied volatility for one-day expirations just spike massively.
While the VIX stayed calm.
It stayed relatively anchored, yeah. The traditional VIX was basically underselling the short-term risk. If you were only watching the VIX, you missed the storm until you were standing in the rain.
So that implies investors really need to stop relying solely on the VIX for intraday sentiment. It's an outdated dashboard for this specific vehicle.
Absolutely. You have to look at the one-day or even intraday implied volatility indices now. The demand for volatility has become front-loaded. Investors are paying a premium for immediate protection, which keeps the back end of the curve, the traditional VIX, relatively stable.
I want to go deeper into this dealer's dilemma with gamma exposure, or GEX. Traders talk about gamma walls. What does that mean for someone trying to navigate a chart?
Think of gamma walls as invisible force fields on the chart. They're just strike prices where there's a massive concentration of open interest.
Okay, so a lot of bets are placed at that specific price.
Right. Now, how the market reacts depends on whether dealers are long gamma or short gamma. When dealers are long gamma, it creates a pinning effect. As the price moves away, dealers trade against the move to hedge, and that pushes it back.
So they're buying the lows and selling the highs, which stabilizes the market.
Exactly. It dampens volatility. The market feels stuck in a range, choppy. That's a long gamma regime. But when dealers flip to short gamma, like we discussed with the April crash, the dealer has to sell into drops and buy into rallies.
Which fuels breakouts.
It fuels breakouts. It expands the trading range.
So if we're approaching a gamma wall and the exposure is negative short gamma, we might just smash right through it.
Yes, or bounce violently off of it. The point is, short gamma signals speed and acceleration. Long gamma signals friction and mean reversion. Understanding which regime you're in is probably the single most important edge a tactical trader can have right now.
It tells you if the floor is made of concrete or trapdoors.
Exactly.
This brings us to the regulatory side. Surely the SEC and the OCC, the Options Clearing Corporation, are watching this and getting nervous. You can't have a car going this fast without new safety rules.
Oh, they are. And they've moved beyond just watching. The response has been focused on margin methodologies. Specifically, the OCC has enhanced its STAN system.
Which stands for?
System for Theoretical Analysis and Numerical Simulations.
Catchy. Sound like a character from a spy movie.
It does.
Yeah.
But the change is technical, and it's really important. Traditional pricing models, like Black-Scholes, they assume continuous market movement. They assume prices just glide from A to B.
But zero DTEs face jump risks.
Exactly. Prices can gap. They can teleport from A to C without ever hitting B.
So the old models were too smooth. They assumed a gentle curve when reality is a jagged staircase.
That's a good way to put it. The OCC is now aligning day count conventions and extending their volatility shock models to specifically account for options with less than a month to expiration.
So they're making sure the clearing members have enough margin to cover these short-dated option risks. They're essentially increasing the down payment required to play the game to account for the speed.
That's a fair way to look at it. It's about systemic plumbing, making sure the pipes don't burst when the pressure spikes. They aren't banning the trade, they're just fortifying the walls.
So we've talked about risks, mechanics, regulation, but let's try to put a number on it. How much does this actually move the market? Is it 50% of the volatility? 10?
Quantitatively, research has tried to isolate the impact of this market maker gamma. The estimated maximum impact on annualized daily volatility is around 3.3 percentage points.
3.3 percentage points. That doesn't sound like Volmageddon.
It's not catastrophic.
Yeah.
It is statistically significant, but it's not the end of the world. It's not the whole story. But you have to adjust your lens. On a 30-minute basis, intraday, that impact can double to over 6 percentage points.
So the zoom level matters.
The zoom level matters. The shorter the time frame, the louder the noise from the zero DTE market.
Yeah.
But again, we have to go back to the flow balance. High volume doesn't automatically equal high risk if the flows are balanced.
If the put-call ratio is near 1.
Right. The danger is only when the market becomes one-sided. When the crowd all runs for the same exit, the door's too small.
So if I'm summarizing, zero DTEs have compressed time frames. They've turned up the volume knob on intraday speed, but they haven't necessarily rebuilt the engine. They're an accelerant, not an ignition source.
That is the perfect summary. They didn't cause the tariff scare in April 2025, but they absolutely determined how fast the market priced it in.
Before we wrap up, we always like to distill everything down to a single actionable takeaway. We call it the one question. If our listeners looking at their trading screen tomorrow, what is the one question they need to ask?
For zero DTEs, the question has to be, is the net gamma exposure, or GEX, at the current strike price positive or negative right now?
And why does that matter in one sentence?
Because positive gamma implies mean reversion and a choppy pinned market, while negative gamma signals the potential for accelerated volatility and explosive directional moves.
There you have it. If you're wondering why the market is chopping or why it is suddenly ripping, check the gamma. It might just save you a headache.
It's the invisible hand guiding the intraday flows.
To conclude, we are living in a new market structure. The days of waiting for weekly expirations to drive flows are over. We're in a daily cycle of hedging, expiration, and rolling positions. And while the April 2025 stress test showed us the system is resilient, thanks largely to defined risk strategies, it also proved that the speed limit has increased.
It has. These are unique tools. For hedging, for profit, they are unparalleled in their precision. But they're a double-edged sword. They require disciplined risk management because that hypersensitivity cuts both ways.
They are, without a doubt, the volume knob for intraday speed. So we'd invite you to take a look at your own portfolio's exposure to these volatility strategies. Are you short gamma without even realizing it? It's a question worth asking.
Always know your exposure.
Thanks for joining us on Talk Tickers. We'll catch you on the next deep dive.